Blue book emoji, Day 2, Currency pairs and how Forex is traded. Bullseye emoji, Objective. Understand how currencies are quoted in pairs and how trades are executed in the Forex market. Brain emoji, What you'll learn today. What is a currency pair? Base currency versus quote currency. Major, minor, and exotic pairs. How profits are made from buying or selling pairs. Spiral notepad emoji, Explanation. In Forex, you always trade one currency against another. That's why currencies come in pairs like euro to US dollar, pound sterling to Japanese yen, or USD/NGN. The first currency in the pair is called the base currency, and the second is the quote currency. Greater than example, in euro to US dollar equals 1.1000, 1 euro equals 1.10 US dollars. If the price goes up, the euro is getting stronger against the dollar. Light bulb emoji, Major pairs, most traded, low spread. Euro to US dollar. Pound sterling to US dollar. US dollar to Japanese yen. US dollar to Swiss franc. Warning emoji, minor pairs, less traded. Euro to pound sterling. Australian dollar to Swiss franc. New Zealand dollar to Japanese yen. Dynamite emoji, exotic pairs, volatile, higher risk. USD/NGN, dollar/naira. Euro to Turkish lira, euro/Turkish lira. Pushpin emoji, practical task. 1. Write down 3 currency pairs and identify. Base currency. Quote currency. Which one you would buy or sell if you think price will rise or fall. 2. Screenshot one currency pair chart on your demo account, MT4 MT5, and share in the group. Black question mark emoji, question of the day. Which currency pair do you want to focus on learning first, and why? Understanding pips, lots and leverage. Objective, learn how to measure price movement, pips, trade size, lots, and how leverage allows you to control larger positions. What is a pip? A pip, point in percentage, is the smallest price movement in a currency pair. For most pairs, 1 pip equals 0.0001. Example, if euro to US dollar moves from 1.1000 to 1.1005, that's a 5 pip move. For JPY pairs like US dollar to Japanese yen, 1 pip equals 0.01. What is a lot? A lot refers to the volume or size of a trade. Lot type units description. Standard lot 100,000 big account sizes, mini lot 10,000, moderate size, micro lot 1,000, best for beginners. 1 pip in a standard lot equals $10, 1 pip in a mini lot equals $1, 1 pip in a micro lot equals $0.10. What is leverage? Leverage allows you to trade with more money than you deposit. Example, if your leverage is 1 to 100, and you have $100 in your account, you can control up to $10,000 worth of trades. Warning, higher leverage equals higher risk. Always manage your risk. Assignment. 1. Define a pip, lot, and leverage in your own words. 2. Calculate how much profit or loss you'd make from a 10 pip move using a micro lot, a 50 pip move using a mini lot. 3. Practice placing a demo trade on MT4 MT5 and screenshot it. Black question mark emoji, question of the day. Would you prefer to start small with micro lots or go bigger with mini lots, and why? Bid price, ask price and spread in Forex objective. Understand how brokers quote prices, what spread means, and how it affects your trade entry and exit. What is bid price? The bid price is the price at which the market, or broker, is willing to buy a currency pair from you. You sell at the bid price. What is ask price? The ask price is the price at which the market is willing to sell a currency pair to you. You buy at the ask price. What is spread? The spread is the difference between the bid and ask price. This is how brokers make money, even without charging commissions. Example, if euro to US dollar is quoted as bid equals 1.1000, ask equals 1.1002, the spread is 2 pips. So if you buy euro to US dollar at 1.1002, the price is to move up by 2 pips to break even. Why spread matters? Tighter spreads are better for traders, for example, major pairs like euro to US dollar. Wider spreads are common in exotic pairs or during high volatility news events. Memo emoji, assignment. 1. In your own words, define bid price, ask price, spread. 2. Check the spread on 3 different currency pairs on your MT4 or MT5 platform. 3. Identify which has the tightest and widest spread. Black question mark emoji, question of the day. Would you rather trade pairs with tighter spreads but slower movement, or wider spreads with higher volatility? Why?
Welcome to day 5 of our 30-day Forex training class. Today's lesson is all about reading Forex charts, understanding candlesticks, and using different time frames. Let's begin with Forex charts. A chart is simply a visual representation of price movement over time. It shows how a currency pair's price has changed, and helps you decide what might happen next. There are different types of charts, like line charts and bar charts, but the most popular is the candlestick chart. That's what most traders use. Now let's talk about candlesticks. Each candle shows 4 key things: the opening price, the closing price, the highest price, and the lowest price for a certain period. If the candle is green or white, it means the price closed higher than it opened. That's a bullish candle. If the candle is red or black, it means the price closed lower than it opened. That's a bearish candle. Candlesticks help you understand the battle between buyers and sellers. You'll also start seeing patterns that repeat themselves, like dojis, pin bars, and engulfing candles. Now let's discuss time frames. A time frame is how long each candle lasts. If you're on a 1-hour chart, each candle shows 1 hour of price movement. If you switch to the daily chart, each candle represents 1 day. Common time frames include 15-minute, 1-hour, 4-hour, and daily charts. Beginners often use the 4-hour or daily for a clearer view of the market. Here's your task for today. Open your trading app, switch to Candlestick View, and explore different time frames. Take a screenshot of a 4-hour chart, and label 1 bullish and 1 bearish candle. Great job! We're building strong foundations step by step. See you tomorrow for day 6.
What moves the Forex market? News and economic factors objective. Understand the key factors that cause price movements in the Forex market, especially news events and economic data. Why does the market move? The Forex market is driven by supply and demand, and those are influenced by economic and political factors. When traders expect a country's economy to grow or weaken, they buy or sell its currency. Key market movers. 1. Interest rates. Higher interest rates often strengthen a currency because investors want better returns. Central banks like the Federal Reserve, USD, or ECB, EUR, set interest rates. 2. Inflation data. Inflation that's too high or too low affects interest rate decisions. 3. Employment reports. Example, The U.S. non-farm payroll (NFP) report, released monthly, often causes big moves in the market. 4. GDP, gross domestic product, measures how fast a country's economy is growing. 5. Geopolitical news. Elections, wars, trade agreements, and natural disasters can create volatility. 6. Central bank speeches. When leaders from the US Fed or ECB speak, the market reacts even to hints of future changes. Where to see this info? Use a Forex economic calendar, like on websites such as Forex Factory, investing.com. There, you'll see the news title, for example, USD interest rate decision, the time it will be released, expected and previous results, a volatility impact icon, low, medium, high. Example: if US interest rates are raised unexpectedly, the USD usually strengthens, and pairs like euro to US dollar may fall. If a country reports lower unemployment, its currency might go up due to confidence in the economy. Memo emoji, assignment. 1. Visit Forex Factory or investing.com. 2. Take a screenshot of today's economic news calendar. 3. Highlight one high-impact news event, the currency it affects, and describe what you think might happen. Question of the day. Have you ever noticed a sharp spike in the chart? What news or event caused it? Introduction to support and resistance. Learn how to identify support and resistance levels on your chart and use them to make better trading decisions. What is support? Support is a price level where a currency pair stops falling and tends to bounce back up. Think of it like a floor. When price hits it, buyers step in and push the price higher. Support is created when price touches a level multiple times and fails to go lower. Strong support equals price has reversed from that level in the past. What is resistance? Resistance is a price level where a currency pair stops rising and often turns down. Think of it like a ceiling. When price hits it, sellers come in and push it down. Resistance forms when price fails to break above a certain level repeatedly. Strong resistance equals price has rejected from that level before. How support and resistance work. When support is broken, it often becomes new resistance. When resistance is broken, it often becomes new support. Example: euro to US dollar bounces off 1.08003 times equals strong support. If it breaks below 1.0800, that level may now act as resistance. How to identify them. 1. Open your MT4 or MT5 chart. 2. Look for areas where price reversed multiple times. 3. Draw horizontal lines at those levels. 4. Use higher time frames, H4, D1, to find stronger support/resistance. Tips. Don't expect exact levels, they're usually zones, not precise numbers. Confirm levels with candlestick patterns or price action. Avoid placing trades directly on support/resistance unless you have confirmation, for example, pin bar or engulfing candle. Assignment. 1. Open any currency pair on your chart. 2. Identify and mark 2 support levels and 2 resistance levels. 3. Screenshot and label them clearly. 4. Share your chart in the group and explain why you picked those levels. Question of the day. Have you ever seen price bounce off the same level multiple times? What might that level be? Understanding trend, uptrend, downtrend, and sideways. Objective. Learn how to identify the direction of the market, whether price is going up, down, or sideways, and why trading with a trend is safer for beginners. What is a trend? A trend is the general direction in which the price of a currency pair is moving over time. There are 3 types of trends. 1. Uptrend, price is making higher highs and higher lows. 2. Downtrend, price is making lower highs and lower lows. 3. Sideways, range, price moves within a horizontal range, bouncing between support and resistance. 1. Uptrend, bullish trend. Price keeps going higher. Traders look for buy, long, opportunities. Structure, higher highs, HH, and higher lows, HL. Example, Euro to US dollar rises from 1.0700 1.0800 1.0900. 2. Downtrend, bearish trend. Price keeps going lower. Traders look for sell, short, opportunities. Structure, lower highs, LH, and lower lows, LL. Example, pound sterling to US dollar falls from 1.3000 1.2800 1.2600. 3. Sideways trend, ranging market. No clear direction. Price bounces between support and resistance. Best avoided by beginners due to fake breakouts. Example, US dollar to Japanese yen stays between 155.00 and 156.00. How to identify a trend. 1. Use higher time frames, H1, H4, D1, for clearer direction. 2. Look for the structure of highs and lows. 3. Use trend lines to draw the direction visually. 4. You can also add moving averages like the 50 EMA to confirm trend direction. Trend trading tips. Never trade against the trend as a beginner. Use pullbacks in an uptrend to buy. Use retracements in a downtrend to sell. Combine trends with support/resistance and candlestick confirmation for better entries. Assignment. 1. Pick a trending currency pair, for example, Euro to US dollar or pound sterling to Japanese yen. 2. Identify the current trend on H4 and D1 charts. 3. Draw a trend line and label whether it's uptrend, downtrend, or range. 4. Screenshot and explain your analysis briefly. Question of the day. Which trend do you prefer to trade, uptrend, downtrend, or ranging market, and why? Introduction to lot size, leverage and risk management. Objective. To understand how lot size, leverage, and risk management affect your trades, and how to protect your capital. Core concepts. What is a lot in Forex? A lot refers to the volume or size of your trade. It determines how much each pip movement is worth in money. Lot type: size value per pip, for Euro to US dollar. Standard lot $1.00 $10, mini lot $0.101, micro lot $0.01 10 cents. Beginners usually start with micro or mini lots to reduce risk. What is leverage? Leverage allows you to control large positions with a smaller amount of your own money. Example. Leverage 1 to 100 means for every $1 you have, you control $100 in the market. Leverage magnifies profits, but it also magnifies losses. Use leverage wisely. Higher leverage equals higher risk. What is margin? Margin is the amount of money your broker locks when you open a trade. Example. With 1 to 100 leverage, you only need $100 margin to open a $10,000 position. If your trade loses too much and your equity falls below the required margin, you may get a margin call. Your trade closes automatically. Risk management is your lifeline. Many beginners lose money not because they're wrong, but because they risk too much. Golden rules. Never risk more than 1 to 2% of your account per trade. Always use a stop loss. Calculate lot size based on account balance. Risk percent per trade. Stop loss in pips. Example of good risk management. You have a $500 account. You risk 2% equals $10 per trade. Stop loss equals 20 pips. Use 0.05 lot size, so each pip equals 50 cents. 20 pips equals $10 loss max. This keeps you safe and helps you stay in the game longer. Common mistakes to avoid. Trading with high lot size because you want to make it fast. Not using stop loss. Ignoring how much you're risking per trade. Over-leveraging your account. Assignment. 1. Practice calculating proper lot size using a lot size calculator online. 2. Pick 3 random trades and write out your account size. Risk per trade, in percent. Stop loss, in pips. Correct lot size to use. Question of the day. Have you ever blown an account due to poor risk management? What lesson did it teach you? Day 10. How to place a trade, buy, sell, SL, TP on MT4 MT5. By the end of this lesson, you will confidently place trades, buy or sell, using correct lot sizes, stop loss, SL, and take profit, TP, on the MetaTrader 4, MT4, or MetaTrader 5, MT5, platform. Core concepts. 1. What is a trade? A trade is simply your prediction of where the market is going next. Buy, long, equals you expect price to go up. Sell, short, equals you expect price to go down. If you're right, you make profit. If you're wrong, you take a loss, controlled by your stop loss. 2. Key trade components. Every trade you place includes term meaning, lot size, the trade volume. It controls how much dollar you gain or lose per pip. Stop loss, SL, a safety exit that closes your trade when price goes against you. Take profit, TP, your profit target. It closes the trade when your desired gain is hit. Entry price, the current price at which you open the trade. Example, buy trade setup, euro to US dollar. Let's say you want to buy euro to US dollar at 1.1000. SL, 1.0980, 20 pips below. TP, 1.1050, 50 pips above. Lot size, 0.01, mini lot equals 10 cents per pip. If the price rises to 1.1050, you gain 50 pips x 10 cents equals $5 profit. If it drops to 1.0980, you lose 20 pips x 10 cents equals $2 loss. Example, sell trade setup. If you think euro to US dollar will fall from 1.1000, sell at 1.1000. TP, 1.0950. SL, 1.1020. 3. How to place a trade on MT4 MT5, mobile or PC. On mobile. 1. Open MT4 or MT5 app. 2. Go to quotes. 3. Tap a currency pair, for example, euro to US dollar. 4. Select trade. 5. Choose lot size, for example, 0.01. Stop loss. Take profit. 6. Tap buy or sell. On PC/desktop. 1. Open MT4 MT5. 2. Click on new order. 3. Fill in symbol, currency pair, volume, lot size, SL and TP levels. 4. Click buy or sell. 4. Understanding pending orders. Sometimes, you don't want to enter the market immediately, but when price reaches a specific level. These are called pending orders. Type when to use. Buy limit, you want to buy below current price. Sell limit, you want to sell above current price. Buy stop buy after price breaks above a level. Sell stop sell after price breaks below a level. These give you control and automation. 5. Risk management reminder. Before placing any trade, calculate lot size based on your risk tolerance. Always place a stop loss. Avoid emotional entries. Assignment. 1. Open your demo account. 2. Place 1 buy trade. 1 sell trade. 3. Use 0.01 lot, 20 to 30 pip SL and TP. 4. Screenshot your trade details showing lot size, SL/TP, currency pair. Question of the day. Have you ever placed a trade without a stop loss? What was the result, and what did you learn from it? Day 10. How to place a trade, buy, sell, SL, TP on MT4 MT5. By the end of this lesson, you will confidently place trades, buy or sell, using correct lot sizes, stop loss, SL, and take profit, TP, on the MetaTrader 4, MT4, or MetaTrader 5, MT5, platform. Core concepts. 1. What is a trade? A trade is simply your prediction of where the market is going next. Buy, long, equals you expect price to go up. Sell, short, equals you expect price to go down. If you're right, you make profit. If you're wrong, you take a loss, controlled by your stop loss. 2. Key trade components. Every trade you place includes term meaning, lot size, the trade volume. It controls how much dollar you gain or lose per pip. Stop loss, a sell, a safety exit that closes your trade when price goes against you. Take profit, TP, your profit target. It closes the trade when your desired gain is hit. Entry price, the current price at which you open the trade. Example, buy trade setup, euro to US dollar. Let's say you want to buy euro to US dollar at 1.1000. SL, 1.0980, 20 pips below. TP, 1.1050, 50 pips above. Lot size, 0.01, mini lot equals 10 cents per pip. If the price rises to 1.1050, you gain 50 pips x 10 cents equals $5 profit. If it drops to 1.0980, you lose 20 pips x 10 cents equals $2 loss. Example, sell trade setup. If you think euro to US dollar will fall from 1.1000, sell at 1.1000. TP, 1.0950. SL, 1.1020. 3. How to place a trade on MT4 MT5, mobile or PC. On mobile. 1. Open MT4 or MT5 app. 2. Go to quotes. 3. Tap a currency pair, for example, euro to US dollar. 4. Select trade. 5. Choose lot size, for example, 0.01. Stop loss. Take profit. 6. Tap buy or sell. On PC/desktop. 1. Open MT4 MT5. 2. Click on new order. 3. Fill in symbol, currency pair, volume, lot size, SL and TP levels. 4. Click buy or sell. 4. Understanding pending orders. Sometimes, you don't want to enter the market immediately, but when price reaches a specific level. These are called pending orders. Type when to use. Buy limit, you want to buy below current price. Sell limit, you want to sell above current price. Buy stop buy after price breaks above a level. Sell stop sell after price breaks below a level. These give you control and automation. 5. Risk management reminder. Before placing any trade, calculate lot size based on your risk tolerance. Always place a stop loss. Avoid emotional entries. Assignment. 1. Open your demo account. 2. Place 1 buy trade. 1 sell trade. 3. Use 0.01 lot, 20 to 30 pip SL and TP. 4. Screenshot your trade details showing lot size, SL/TP, currency pair. Question of the day. Have you ever placed a trade without a stop loss? What was the result, and what did you learn from it?